This is the full course and training on everything you need to know about the Theta Fairy strategy. And so here's the back test. We'll be diving more into it in a second, but you can see here it tends to be pretty consistent. I'll be showing you some tweaks as well that you can make to make this even more consistent and more profitable. So stay tuned for that. We can see overall a decent one. You can see here that it does have a little bit of a drawdown, but I'll show you some more settings as well that we can change to actually decrease that. But this is a Theta Fairy strategy. It was made popular by a YouTube channel named Drawbridge Finance, where he teaches this overnight Thursday trade that can generate you as much as $500 every single Thursday. And so this is a fun trade to do. I wouldn't take it as your main income source. So if you have another strategy like a 111 or strangle long term to use as your main income, and then use this for fun on the side. But it was popularized by him and has been used by thousands of traders since. Now, here's the game plan for this training so that you guys know what you're in for and that you know you're going to get some great value. You're going to learn why you should trade the Theta Fairy strategy. You're going to learn how to structure it, the DTE, the strike selection, and everything, and how you can adjust it to increase your win rate. You're going to learn how to manage the Theta Fairy trade, the take profits, the stops, and everything you need. You're going to learn the Theta Fairy strategy, the risk part of it, how to mitigate that risk, how to size it in your account, and how to scale as you grow. You also learn how I personally trade the Theta Fairy strategy. You'll see a real trading example. I will share my screen. I'll go into the broker, show you the strike prices I'm selecting. So that by the time you get done with this trading, you can walk away knowing exactly how to do it. And guys, this training is on Wednesday, a few hours before the market closes. And I did that because these trades should go on Wednesday. And so again, we can hopefully put those trades on together. We can also do it through paper trading as well. I'll show you some of the advantages and disadvantages so that you know the whole landscape of this strategy, and you'll learn how to trade it in different markets. And then I'll also show you how to turn it into a passive income machine and how you can fully automate it if you want to do that as well. So before I get into the fun stuff, I need to say a legal disclaimer first. This training is for educational and entertainment purposes only. I'm not a financial advisor. I definitely don't control the market. If I did, we'd all be rich. Trading is risky, and 99% of people lose money because they over leverage, ignore risk management, or think a few lucky wins make them a market genius. Past performance, whether mine, somebody else's, or a back test, does not guarantee future performance. So don't bet the house, your retirement, or your dog's college fund on anything you see here. By watching this, you agree that your trades are 100% your responsibility, and if anything goes south, or your broker is not me who took your money. Anyways, do you agree? If you don't, leave this training now. All right, let's see. I'm going to watch. Is anyone leaving? Just kidding. Okay, that's the disclaimer. Let's move in. Why trade the Theta Fairy strategy? Number one, it's a simple mechanical trade. Every single week, you do the same thing. You pick the same strikes. You manage it the same way. So someone who's looking for something simple that follows the same process every time, that would be this. There's no chart reading needed. You don't need to go map out the chart, see what it's doing, draw support and resistance. So if you're a little scared of charts, you don't need to do that for the strategy. It can easily scale. Now, again, this is a large account friendly strategy. By that, it's tailored for larger accounts. I'll show you how to do it for smaller accounts as well. But it definitely can scale no matter what size your account. It can profit quickly. Again, you're only in this trade for about a day. And so it's not even a full day. It's just overnight. So it's an overnight trade. So you can profit relatively quickly compared to most strategies. But I do want to say a word of caution. This strategy is not for everyone, as you'll learn here a bit in this training. This is more for larger accounts looking to diversify or add a fun strategy to their portfolio. But I'll also show you how to structure this for smaller accounts, so don't worry. Next, how to structure the Theta Fairy strategy. So it's quite simple. The goal of this trade is to make money due to the overnight data decay. And if you don't know what this is, as option sellers, we make money as time goes on. It's called theta decay, time decay, which means as time goes on, we make money. And so that theta decay gets the strongest and makes us the most money the closer to expiration we get. So if we do an overnight trade with a 1 DTE trade, we can collect a lot of data just from the time that passes over that night period. And so we'll pick up all the overnight data decay as long as the market stays relatively neutral. So here's how you do it. First, we need to pick our days until expiration. This is a 1 DTE trade, which we need to go 1 day in the future. This means this strategy is done on Thursday and will go until Friday. The strike selection. This is, again, by default, how this strategy is done by the general public, is what I'm showing you right here. And then I'll show you how I change it a bit. So the general public does a one standard deviation strangle, which means they sell the 16 delta put and they sell the 16 delta call. That's typically how this trade is structured. You target a credit of about $10 to $20. So if you can't get more than $10, you typically stay out of this trade because it's not worth it. But this is typically your credit target range. Next, your entry time is going to be 1 minute before the market closes. Again, if you're doing futures options, you can do actually a bit after the market closes. But again, either way, you're getting in right as the market closes. Your ideal assets for this is going to be futures. Futures are the preferred assets for the strategy. It was created as a future strategy. And the reason being is futures options trade overnight. So if something goes wrong, you could easily get out of the trade. And so that's why ES and MES would be the preferred assets for this. However, if you don't have access to futures options, no worries. You can also do this on SPX and SPY. You'll just have a little more risk because you can't close it overnight. You'll have to wait till the market opens the next day. So now that we know how to structure the trade, how do we manage the trade? If you're wondering, Austin, this is too much info, I don't quite get it. Don't worry. I'll start sharing my screen here and I'll actually show you how to select these levels in the broker so it makes sense. So once we're in the trade, how do we manage it? Take profit and stop loss rules are virtually non-existent if we just let the trade go overnight. If we're doing futures options, we can set about a $100 profit target and a $200 stop loss, depending on how you want to structure that. But if you're just letting this trade overnight, then you're not using any of those rules, and you're just closing the trade early the next morning. So around market open to around 10 a.m., you're going to let the market open. You're going to let the opening movement and volatility fade off. So that volatility comes a bit down. Theta decay has more time to take effect. And then what you're going to do is from there, you're going to close out that trade early around the 10 a.m. mark. So quite simple. Let's just go back here. So we're going to enter strangle. We're going to sell the 16 delta put, sell the 16 delta call. We're going to enter right as the market closes, and then we're going to close it shortly after the market opens the next day. So literally an overnight trade. And so now you may be wondering, okay, this seems cool, seems pretty straightforward, but what are the risks of this strategy? And that's something you should be asking for every strategy you trade. Where does this strategy fail? And so we can look in how to mitigate it, or purely just stay out of the market during that time. And so risk number one is overnight risk. This is common sense here, right? If we're trading overnight and something were to happen in the economy or news-wise overnight, we will be impacted. And that's the problem. The problem is you give up control by holding a trade overnight. And so the solution is, again, use futures options with a stop loss or take profit. So about, I think pretty standard for this trade is a $100 take profit and roughly a $200 to $300 stop loss is how you typically trade this on futures options. That way, if something goes wrong overnight, you're able to get out early. And so that's the recommended solution. If you're not doing futures options, this is a risk that you can't mitigate. You just will always be stuck with it because you can't trade options overnight. Now, risk number two is manipulation risk. Okay, so the problem is stop losses and limit orders can lead to losses due to market makers manipulating the option price. What does this mean? This means that when you put on a limit order or a stop loss to enter or exit a trade, that order then sits on the market. And as it's sitting on the market, anybody can go see it and move the option price to get your order to trigger sooner. And so that can lead to premature exits and losses for no reason. And so the solution is to only submit an order when you're ready to exit, or to use an automation, which I'll explain later. But if you're doing this by hand, only submit the order when you're ready to enter and ready to exit, but don't expect it to work as a lasting stop loss, especially overnight when the market orders can move a lot. Risk number three is volatility risk. Okay. With this risk, the problem is VIX spiking can lead to huge and sudden losses. And so how do we fix this? We need to adjust our buying power usage based on VIX. If VIX is lower, our risk of huge and sudden losses is higher for this trade. So what we'll do is we'll avoid entering on most days that have news, which is good because it's overnight, so that's not news related. And then we can also adjust how much money we're using, how many trades we're in based on where VIX is. And so these are two ways to reduce the risk of the Theta Fairy strategy. So now, How do I personally trade this strategy? Now, I will admit this is not one of my popular, not one of my go-tos. I do this on it on occasion when I want to do it for fun, which is how I recommend that you trade this. I do know some people who trade this for purely income and they can make it work, but I personally don't like putting a large portion of my money into an overnight trade. But if that's you, go for it. It has worked out for people. But again, I use this as a fun trade. And so here's how I trade this to increase the win rate. Number one, days until expiration, so 1 DTE. My strike selection is a bit different, okay? Instead of doing a normal strangle, which I'll explain here in a second once I stop doing the slides and I go to screen share, I'll show you why. But I use a skewed strangle. So that's being a 10 delta put and a 5 delta call. And so my credit target is a bit lower. It's about a $5 to $10 credit target. So I'm going to make about $5 to $10 in credit for this trade. My entry time is on Thursday, about a minute before the market closes, and that's how this trade's structured for me. Now, how do I manage the trade? I do an early management where I exit the next day at 10 a.m. as well. So I still follow most of the best practices that it's done with this trade, but instead of doing a normal strangle, I skew that strangle, and this helps me smooth out my returns and have a higher win rate. It does sacrifice some profit, but that's what it does. Now, my preferred assets are ES and MES, and as mentioned before, this is because I'm able to control risk by exiting overnight if needed. ES is the preference, but it does take a lot of buying power, which we'll dive into in a second. And then MES is the next option, but understand that there's lower volatility or a lower trading volume there. Here's the backtest of the original strategy, the 1 standard deviation strangle on Thursday night. You can see here your average winner is about $500 to $1 per trade. Your average loser is about 500. Again, you can have larger winners and larger losers depending, and a 73% win rate. Again, 16 delta for each trade, and this is what the performance looks like. Overall good, but I want you to look at something here. Look at how much this curve moves and how wild it is, and then look at the max drawdown that we see over the different years that this has been back tested. Now we go to my version of it here. You can see our returns smooth out. We have less huge drops, less jagged moves, and it's more consistent of a move. You could also see here that we cut our max drawdown by 50%. So we have way smaller losses. And this is why it makes it more consistent and more fun to trade. It also bumps our win rate from 73% to 80%. And so now I was like, what's the main difference? The only difference is how I structure the strangle. Instead of doing a 16 delta each, I do a 10 delta put and a 5 delta call. That way I give myself more room to the upside because in general, the market moves higher. If you don't know what I'm talking about, don't worry, I'll show you here in just a second. But you can see here, way more consistent. There's also a way to do this for small accounts, and you do that by capping the ends and by capping the losses and turning your strangle into an iron condor. You, instead of just selling a put, you're going to sell a put credit spread. Instead of selling a call, you're going to sell a call credit spread. This cuts your buying power by a ton, but your performance will suffer. You can see here, you'll still have about a 70% win rate, but you'll see a lot of periods where it's just a lot more rigid and you don't see that consistent smooth performance like you would from this strategy here. And so again, that's why I mentioned this strategy is intended as a fun strategy, at least in my opinion, for larger accounts who this is not their main income strategy, using a strangle or 111 or 112 even as your main income source instead. So account sizing, remember the 5% trade rule. This means have no more than 5% of your account into any one trade. So this means if you have a $100,000 account, then you should only have $5,000 in a trade. And so this kind of hints at the fact that you should have a larger account when doing this trade. Again, you can also define your risk by turning it into an iron condor, and that can help as well. You can also add a stop loss to help how much your risk is as well. Now, how do you scale this trade? Okay, if you have less than a $10,000 account, if you want to do this, do the small account strategy where you turn the trade into an iron condor, but you keep everything else the same, and you run that on SPY and MES. This is your small account. Between 10 to 25,000, you can do the small account strategy, but you can bump it up to bigger assets, meaning doing the iron condor version of this, but on SPX and ES. If you have 25,000 to 100,000, you can do the normal strategy on the smaller assets like SPY and MES, and then 100,000 plus, you can more easily do the normal strategy, which is to strangle on the larger assets like SPX and ES. All right, tip. use this strategy, as I mentioned before, as a fun strategy and not as your main income strategy. All right, so I'm going to screen share. We'll go to a whiteboard, explain this a bit more in depth, go to the broker, show you how to place it, then we'll look at a risk profile, okay? So if we're going to the screen share, can you guys see my screen? Let me pull up the chat, make sure we're doing good. Perfect. Yeah, my bad. Yeah, perfect. We can see screen, and I'll get to your questions as soon as we get to the end of this training. We'll have the Q&A session for probably about 30 minutes. Okay. So diving into it here, when we're looking at it, what the strangle is, let's say the stock is trading here, right? Let's say the stock is trading here. What we do is we enter a 1 DTE trade on Thursday, and we set up a strangle. So this would be a 16 delta strangle, where the distance to the upside and the distance to the downside is roughly the same. Okay, this means that if the market goes up and goes down, we have an equal chance of each side being hit. And this is how the normal theta fairy strategy is run. If the market stays in this level overnight, you make money. Okay. Now, how I structure mine is I know that the market tends to move higher, right? The US economy tends to perform well and go higher. So I give it a little bit more upside room. This way, my goal is still for it to profit by staying in this range, but it allows it a higher drift. So if it continues to go higher, I'm going to be able to make some money. And so that's how this trade is structured. Again, every Thursday towards the market close, you put on this trade and you let it go on. And so that's the look and feel of this trade. You just want to stay between these two levels. And if you skew it in your favor, meaning you give yourself more upside room, you increase your win rate, which means you smooth out your profit and loss return. So that's just a quick look at how that strategy works. Can you guys see my Tasty Trade account? I want to make sure you guys can see that as well, so we can go into how it looks in the broker account. Not yet. Okay. Maybe I have to share it specifically. Let me stop share. Okay, I have to share it specifically. Okay, cool. Can we see it now? Perfect. We can see. Awesome. Love it. Okay, so let's structure this trade and let me show you how. And like I mentioned, I want to do this on Wednesday so that if you want to do it, you can be good to go for tomorrow, which is Thursday, and try this out. Again, always paper trade things first. So if we go into it, again, the ideal asset is going to be ES. And we'll also look at how this compares with a small account strategy here in a second. But you go to ES, you go to trade, table, and then from here, what we're going to do is we're going to structure this trade. So again, it's a 1 DTE trade. So if we're doing this on Thursday, we're looking for 1 DTE. So I'm going to pretend like I'm entering the trade today. So 1 DTE, 1 day out. Then what I'm going to do is I'm going to, again, I'm going to do my preferred strategy when I do this. Again, not as often as a weekly basis, but I probably do it once a month. And what we see here is I do the 10 delta on the put. So basically, I'm coming to the side on the right column. I'm trying to set my setting to delta, which is right here. And I'm looking for 10, or the one closest to it. So you can see right here, 10 delta. I'm going to sell this mark. On the left side of my calls, I'm going to move to a 5 delta or closest to it. So you can see here I have 6 delta and 4 delta. Since 6 delta has the most volume, I'm going to pick that one instead. So just like this is what my trade looks like, okay? These are the levels in which I'm trying to make some money, which is great. You can see here that I am going to collect about $3.55, which is lower than I typically like. And because of that, this is one reason why I want to enter this trade. But you can still see here what's going on. Again, like I mentioned, my credit target is around $5 to $10. If I'm in that range, I'm golden. This typically leads to smaller losses, but let's just continue on. So you can see here my max profit is $175, and you can see my theta decay is about 308. So you can see the theta is very high for this trade, which means I had the chance to make a lot of theta decay from this trade. And so that's what the goal is here for this. Now, looking at this, it takes about $15,000 to put on this trade. Now, if you put on a stop loss, this will limit that amount a lot or allow you to use less money. But if you're just doing this open-ended with no stop loss, then again, this is going to be a decent amount of money. So you want to make sure it's not taking up a large portion of your account. So $15,000 with the chance of making about 100, 150 based on our average returns. And so again, it's about less, it's about a 0.01 or about a 0.1% return for an overnight trade. It's just a fun one to do. So that's how it looks. Now, if we look at it from a curve, so I go to analysis and look at curve, we can actually look at what this is doing here. It's zoomed out too far. And so you can see the profit graph here. Let me scale this up so you can see a bit more. Okay, just like this. So you can see this flag is where the stock or where ES is currently trading. It's just trading right here around $6,080. The this trade makes about $100 and $150 as long as it stays below 6,145 and stays above $6,010. Roughly these numbers. As long as it stays here, this is where that profit target is, and you let this go overnight. So you'd enter this on Thursday. Whoops, on Thursday, you do the 1DTE trade, and this is how you would structure it. Now, what if you wanted to do this for a smaller account? Then you would just define your risk. Go out to about the 5 delta level, depending on how you want to do this. But again, you can see here about 5 delta away. So if I have about 5 delta here, I'll probably go to about 1, which again is not something I want to do. So I'll probably go to about 2. Look for one with the best volume. So something like this. Just like that. Oops, that's a sell. Now I define my risk. So obviously I make less money, but my buying power just dropped to $400. So again, I'm only going to make about 50% of this, so maybe $45 or less. I think my premium capture credit is only about 20%. So actually about 20% of this. So maybe about 18 to $20 on this. But you can see here, the buying power drops massively. Again, you can also extend this out. It will increase your buying power, obviously, but you'll be able to collect more profits. You can see your buying power of $1,000, the max profit of 132. And so that's one way you can decrease your buying power for smaller accounts. And so that's how it's done on futures. It's done the exact same way on SPX or SPY, but ideally you want to run this strategy on futures in case you need to get it out overnight. You can. Okay, so that's the profit graph. That's how we do it in the broker. That's how we pick the strike prices. I hope this is all making sense. I hope you guys are getting this. Are you guys getting this? Let me know in the chat. This is making sense? You getting it? Philip says, yep. Awesome. Sweet. Glad to hear. We got one person out of about 60 value. We got a thumbs up. Okay, cool. So I'm going to stop sharing here. I'm going to jump back over to the original screen. I'm going to jump into the slideshow and continue this party. Okay. So we just covered the whiteboard. It's another look at understanding how strangles work, where the profit zone is, why we skew it. Look at how to do it in the broker, then look at the risk profile, where it makes money and where it doesn't. Okay. So what are the advantages of using this strategy? Okay. It generates consistent income. Okay. As shown by the back test, especially when we skew it, it can be used to generate some income. Now, I like to use this as fun money, but again, if you want to use it for consistent income, please do more research on it and test it out first. But also, it's very easy to set up. You literally only have 2 options to worry about, and you do the same thing every single week. So it's very consistent. It requires no adjustments, okay? You get in the whole trade, you exit the whole trade. You don't need to close partial, close one leg, do whatever. Sure, you can make it as advanced as you want, but the ideal strategy has no adjustments. Now, what are some of the disadvantages to consider? Well, you do have the potential for very large losses. Obviously, we saw there that the average loss is a bit different. So the average loss for the skewed one had about a max loss of about 1,500 or so. So you could have decently high large losses, specifically compared to the profit you're taking. So that's why I make sure that I collect the minimum credit to make sure that my profit will outdo my losses when they come. There's no protection from overnight movements unless you're trading with futures, in which you can do more risk management approaches for this. And also, if you do this on SPX or SPY, you do have assignment risk, meaning that you can be given shares because your contracts go in the money. I should say more for SPY than SPX, because SPX doesn't have assignment risk, it's cash settled. But then again, you also don't have that with futures because you're going to get out the next day and they don't assign early, only SPY does. So next question, you're probably asking, okay, this is cool. Now, how do I trade this in different markets? So it's awesome. What if I'm in a bullish market? How do I do it? What if I'm in a bearish market? How do I do this? Okay, so it's quite simple. First off, we'll start with bullish markets because that's the easiest. Now, what is a bullish market? It's defined by higher highs and higher lows. So if the stock market on a graph is going from the bottom left-hand corner to the top right-hand corner, meaning it's moving higher, that's a bullish market, okay? How do we do this? Follow the ideal trade setup. Okay, this is the skewed strangle for the Theta strategy, where you're selling the 10 delta put and then you're selling the 5 delta call to give you more upside room. Now, what about bearish market? This is lower lows and lower highs. And so this means on the chart, it's going from the top left-hand corner to the bottom right-hand corner. This means it's moving down. What do? Well, we consider staying out of the market Oh, I realized I forgot to update this from the other one. My bad. We consider staying out of the market as one option, or we do the inverse. Okay. And by that, as we do the 10 delta call and then do the 5 delta put. But more times than not, in bearish markets, I like to stay out of the trade because it can just move a lot to the downside and will most likely break the level of my strangle. Now, in sideways markets, this is ideal. Same highs and same lows. So if we're getting capped out at the same spot, we're topping out there, and we're also bottoming out the same type of level. This is called a sideways market. And you follow the ideal trade setup. This is when data decay will work most in your favor because nothing is happening. So you're just getting the effects of beta. If you want to collect a bit more, you could even make the same one due to a one standard deviation strangle, 16 delta, 16 delta. That's because you'll collect more profit because the market's not going anywhere. But more times than not, we're in a bullish market, and so we want to use a skewed strangle. How to automate the Theta Fairy strategy. Step one, join the options auto trader. This is an automation tool that most of you guys, I'm pretty sure, are aware of. Step two, you can connect your broker account to it. Step three, all the rules that I gave you for the Theta Fairy, just go in and plug in those rules. And next, you can sit back and let it trade safely and hopefully generate some monthly income for you. So I'm going to show you a quick 3-minute demo, and then I'll actually share the link to the bot so that you guys can use it if you want. So if I go here into the options auto trader, this is the little website and software that allows me to automate options trades. What I'm going to do is I'm going to create a bot for the Theta Fairy bot. And so again, I'm going to do this around the way that I do it, which again is creating an auto trader. I do a strangle trade, right? Because it's a strangle. I personally do it on ES. Okay. If you don't have access to futures options, you can do it on SPX or SPY as well. This is a 1 DTE trade. I sell the 10 delta put and I sell the 5 delta call. So put delta 10, call delta 5. Perfect. Next, I set up my entry rules. Okay. You can see here, I enter on Thursdays, but I enter at a specific time and I enter, this is EST. So I enter 3. Let's just go 3:58 p.m. So 3:58 p.m. right as the market closing, that's when I get into this trade. Now, something that I'll also do is I'll click on advanced entry rules. From here, what I'll do is I'll do a minimum credit per trade of $5. And I'll just keep it there because I like to at least make sure I'm collecting $5 in credit. That way I have enough profit to offset any future losses. And so a minimum $5 credit. Next, how do I manage this trade? Again, if I'm doing the futures options, which I am, I like to have about $100 take profit and a $300 stop loss. So I would do dollar amount of 100. Now, the reason why I didn't factor this into the back test is because at the current moment, there's no way to back test futures options. And I just had to do an overnight trade for that. So if that's all you can do because you're trading SPX or SPY and you can only do the whole overnight trade, it still works out well for you. But just like this, I like to target 100 or 300. And if I can't, then I want to get out on the last day. So 0 days left at 10 a.m. 10 a.m. Perfect. So I ideally want to get I want to either take profit or close the trade. But if I can't, then I'm going to exit the next day for whatever I'm at. And that's how I'm going to do it. Next, moving in is how much money do I want to allocate to this? So like we saw, this trade takes at least $15,000. So if I was to put on this trade, it's going to be about $20,000. Although my risk will roughly stop out around $300, the broker still requires about $15,000 to put this trade on. And so I can do it just like this. And I can save and continue from there. Again, around $100 return and $300 per credit where we're capped out. If you don't want to do that, if you want to have no take profit and no stop loss because you're doing it overnight, that's completely fine as well. Don't worry about it. That's what the back test is based on. So I'm just slightly changing it. So next you can see here, that is the auto trader. I now have my ES1 DTE strangle. I'm going to come back in here and rename this puppy as the Theta Fairy strategy. I'm just going to say skewed plus managed. So I have my management rules. So I'm going to save that. And this is how I would run it. Again, paper traded first, of course, but I'm going to share this with you guys. Sweet, it's been copied. Close this. Post that in the Zoom chat right now to make sure you guys get it if you want to do it for yourself. You can go check that out in the little link there. So I just put that template there. So now you can go use that if you'd like. Let me continue